Let us now look at the capital structure components. Debt and equity are the two primary types of capital sources for a business, as I mentioned earlier. And capital structure is the combination of equity and debt that is put into use by a company to finance the overall operations and for its growth and sustainability. Before we get into this slide, I also want to mention, practically, I have seen very scant attention being paid to working capital planning and budgeting, and also for deficit financing. Working capital management involves overseeing a company's short-term assets and liabilities to ensure sufficient liquidity for ongoing operations. We will examine this in greater detail towards the end of this particular section on capital structuring. But for now, let us turn our attention to the overall capital structure. This might sound a bit didactic as I introduce this principle, but just bear with me. Okay, so as you see, we have different types of components that make up a capital structure. The first is debt capital, and this refers to the monies that are borrowed and utilized for the business. And there are different forms of debt capital. They can be long-term bonds, LT bonds. These are types of bonds that are considered the safest of the debts as they have an extended repayment period, and only interest needs to be repaid while the principal needs to be paid at maturity. You can also have long-term loans from banks, which are slightly different, where the interest and principal are paid as part of a repayment structure that is agreed with the bank. The second component is equity capital, right? And the equity capital is basically money that is owned by the shareholders or the owners and investors, and can generally have two different flavors. The first is RE, or retained earnings. So retained earnings are part of the profit that has been kept separately by the organization, which is part of their operations, and then put back into the business, reinvested into the business to strengthen its growth and expansion plans. There is also something known as contributing capital. And the contributing capital is the amount of money which the company owners have invested at the time of opening the company, starting the company, or have received funds from the shareholders as a price they pay for providing ownership into the company. I've also included two other forms called the working capital and the deficit capital. And the working capital is normally financed by short-term debt instruments, like a short-term commercial paper. And this is a type of debt instrument that is used to raise capital for a short period of time to deal with day-to-day OPEX and operational expenditure. I just want to again reiterate that working capital, I call it the orphan child of capital structure in companies, because I've just seen with so much frustration, barely any attention being given, and the stress that companies undergo because of not adequately planning working capital funding and poorly designing their overall capital structure. Let us now get into the details.